Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the world of finance, business, investing and politics to find out what's really going on out there and what we can best do to survive this pandemic now and hopefully thrive in the aftermath. My guest today combines being a media entrepreneur with being one of our most prolific financial journalists. He's got regular columns in the Financial Times, Money Week and Investment Week. And in the online world, he's a strategic advisor to AltFi, as well as having his own very much sought after and followed blog, The Adventurous Investor. The clue is in the name. You can always rely on him to come up with some kind of new approach to investing that you hadn't heard of, and almost certainly your mainstream financial advisor wouldn't have heard of. His name is David Stevenson. David, welcome to Money and Me.
Hello there. Hiya. Hi, Graham.
Hi. Well, could we perhaps just start at a macro level? What's your kind of big picture view of where we're at the moment? And what are the sort of main themes that investors need to be paying attention to?
Oh, it's a very broad question. I suppose I should caveat everything by saying that I'm not entirely sure that COVID has changed that much. I think a lot of the things that maybe we'll talk about were kicking around before COVID, and that all that COVID has done is accelerated certain trends that are out there. So I give that caveat. I'm slightly skeptical. I run a media company and everybody says offices are finished and physical events are finished. I'm not completely convinced. You talk to all the people who work for me who are young and they're desperate to get back into offices. We have to hold them back, and they can't wait to turn up to physical events, for instance, and they want to go travel. So, so the caveat is I'm not completely convinced that everything has changed. And as I said, I think, as we'll talk a bit about, a lot of the things that you need to watch out for were out there anyway, and they've just intensified. So a good example of that is the one thing all investors really need to think long and hard about, and there's no right or wrong answer to this, by the way, is we are seeing a lot more government intervention and central bank intervention. So the printing presses, not that we have them any longer really in that traditional sense, but the printing presses are red hot. Governments are going to be incurring huge deficits, and we're seeing a vast expansion of liquidity, global liquidity at the global level. And there's ways of measuring that, and there are research outfits that do it all the time, and they are all saying this is a vast expansion of money in the system. That was going on before COVID, and it's just simply intensified. But the investment question here is, what do you think will happen in 2022, 2023, 2024? Not what will happen next year or next month. What do you think will happen in those 3, 4, 5 year medium term? And I said there's no right or wrong answer here, but they do affect how you plan your investment portfolio. Because if you think, as some people do, that it's going to result in much higher levels of taxation on wealth, for instance, which I think it probably will, rightly in my view, many people will disagree with me, then you need to plan around one eventuality. If you think that one of the big issues is going to be inflation, because if you pump all this money into the economy, global economy, and you have supply constraints, i.e. there's lots of businesses being shut down, lots of industries aren't responding the way they're supposed to, then you might see the supply side challenged, all this money flooding in and prices going up in 2023, 2024. And if you think inflation is going to be a big problem, there are a whole series of solutions. For instance, property is always a classic real asset hedge against inflation. If, on the other hand, you think that actually, and this is possible, and actually is even probable, that when we come out of the COVID situation, the economy is going to really boom. And I think we could see a kind of recurrence of the manic, frantic 1920s after the 1918 Spanish flu. Young people getting out there, enjoying themselves again, the economy coming back to capacity, all that money sloshing around the system, the stock market carries on increasing in value. And actually the economy doesn't do too badly, because actually some of the things we've talked a bit about, with more redistribution by governments and more money in people's pockets. In America, quite literally money in people's pockets, because the American government sent them a check during COVID, yeah? Then you could, for instance, think that the stock market has another 5-10 years of amazing growth left in it, in which case you might be going towards the stock market and putting your money in equities. Now, I don't know. All of those could happen at the same time, or they could happen independently of each other. So, but as you can see, they're all continuations of existing trends that were already out there: quantitative easing, low interest rates. How do you protect yourself against inflation in the future? The demographic shifts that are going on in society, and COVID simply sort of accentuated those big trends.
Okay, I mean, you touched there on the money printing and quantitative easing. To be fair, yes, it was already there, but it's gone up on steroids in the last few
Yeah,
months. Look at the Fed Reserve balance sheet, for example.
yeah,
I suppose one of the things that makes me worry about all this is the loss of what you might call price discovery, because you've
yeah,
got loads of people doing passive investing where they don't care what the price is. You've got the Fed now doing direct purchases of ETFs and things.
yeah.
You know, how can us ordinary investors know what a fair price is when there's all this manipulation going on?
Yeah, and again, by the way, a continuation of existing trends. So even before COVID, there were plenty of people in America who were saying that passive funds, exchange traded funds, ETFs, were the work of the devil. They were a Marxist invention. I think the analyst from Sanford Bernstein once called them. They were a kind of communist takeover of American capitalism. And that was before COVID. And you're absolutely right. You know, the US Federal Reserve, the central bank, has been buying bond ETFs. Not really in large scale, in truth, yeah, but it has been buying them, and the Japanese central bank certainly has been. Yeah, price discovery. Yeah, it's an interesting one, that. And let's look at it through the prism of passive funds, because you mentioned them, and a lot of people, for instance, that Stanford Bernstein's paper said actually that all these passive funds are price takers. They're price takers, not price makers. Yeah. So how do we know price discovery? The honest to God truth, though, is that roughly half of all retail funds in the US at the moment are passive funds. The other half aren't. The other half are active. And actually, there's a lot of evidence to suggest that as passive funds get a bigger and bigger share, most people don't think they'll go above 60, 70%. Active fund managers will do terrifically well. I sit on the board of a fund called Aurora, an investment trust. Very active manager, UK equities, very, very Warren Buffett style. And I imagine he's rubbing his hands at the thought of all these passive funds out there, or people sticking all their UK equities money into FTSE 100 or FTSE All trackers. I think he's delighted, yeah, because actually people like him can do the price discovery. And in a more general scale, so that passive versus active debate, but in a more general scale, the markets are remarkably efficient at finding a price, yeah, even with central bank intervention, because the central banks are using existing channels to funnel the money through to the economy. So do I think that we'll have true price discovery in property, for instance? Yeah, probably. I think we're in the process of having true price discovery in property, in retail property, for instance. You know, there's going to be a very brutal phase in the next 6 months. We're already seeing it with the big real estate companies, where that price discovery process is happening with abandon. Yeah. So I think that what you need to sort of compartmentalize is all this money swishing around the system, yeah, and definitely pushing up asset prices. I don't dispute that at all. That's absolutely the case. But I think that the price discovery mechanism is alive and well. And in fact, the only area that I would be worried about, and I'm not actually even worried about it at the moment, is that so many people are desperate to get an income, yeah, that they are basically jumping on any kind of alternative sources of income they can get their hands on. Yeah. And what we're beginning to see are maybe some evidence that some of those kind of alternative sources of income, because if you're not going to get a savings account that's going to give you anything more than 1%. You're not going to get many bonds that you really want to invest in that will give you much more than 2 or 3% at kind of like safe level. So a lot of people are jumping on 5, 6, 7% alternative sources of income. And some of those are really very good ideas. I champion them and I think they're great ideas. Some of them less so, yeah. And we know that that's the case because we've seen lots of people buying mini bonds, yeah. I inveighed against them many years ago, thought they were a terrible idea then. I still think they're a terrible idea. Lots of people bought these dodgy mini bonds thinking that, 7, 8, 9, 10% yields. Well, that doesn't really exist, not in a safe way. So I think there are worries around the compression around income, and because people still need an income. Yeah, that's the brutal truth of the matter. Particularly if one's retired, you need an income. You've got to get that money from somewhere. And there, I think price discovery, your point, might be more problematic, because the weight of money will be so huge, the number of quality opportunities so small, and the yield going down all the time, that you'll probably see poor price discovery.
Yeah, and I mean, to be fair, if you look at what might be regarded as a safe haven, you know, gilts, US treasuries and so
Yeah.
on, a lot of those are in kind of zero to negative territory.
Yeah.
Well, is their price activity just being driven by central bank buying? And you know, should we follow the money, or should we stay well away because it's an accident waiting to happen?
Well, I think the truth of the matter is there aren't many retail investors buying government bonds at the moment. Yeah, and certainly not at the low yields you're talking about. I think it's mostly institutional money, and the reason why institutional money is chasing it is because they can make money out of that. So, classic example: I wrote a piece a while ago saying, why would anybody want to buy a 100-year bond off a sovereign country? Yeah, for yields of 1-2% a year. Why would you want to do that? That sounds crazy. Yeah. No, actually, it's not actually a crazy trade. And I'll tell you the reason why it's not a crazy trade is because if you're an institution and you're willing to sit tight for the next 2 or 3 years, buy that at 1.5% as it comes out the factory gate, pretty much within a year or two, that will probably be down to 0% yield. Yeah. Because there's so many people wanting to buy it. And actually, you've probably made good profits on it. Yeah. Now, institutions can do that. I don't think there are many private investors in truth doing that, because I think they probably sit there at the beginning and think, why would I want to lend money to the Austrian government for 100 years, 1.5%? It's crazy. So I tell you what, I got trained as an economist, and the one thing that got drilled into me as an economist when I was young was the world's a messy place, yeah. And our attempt to kind of impose narratives of right and wrong, bad or good, can sometimes be messed up by the fact that some people have seen an angle that you and I haven't seen, and because they've got the money to deploy, they can.
Yeah, indeed, and I think the scale of that deployment, certainly if you look at what's happening in America, is quite mind-boggling. I mean, do you see potentially a risk to the position of the US dollar as a global reserve currency from the sheer scale of currency creation that's now happening?
Yeah, it's very interesting. I wrote a blog saying what should investors do, literally last week, if America is actually falls. You know, I'm a kind of classic transatlanticist. I believe in the transatlantic alliance. I believe that we need to stick close to the Americans, and I have no desire for America to fall. But you know, the odds of America having a catastrophic failure have probably gone up from kind of 1 in 1,000, 1 in 100 to probably 1 in 20, 1 in 13. And it doesn't have to be a genius to work out what may go wrong. Yeah. You could have a Chinese bond buyer strike. I think that's unlikely, because I think it would be devastating for the Chinese government as much as it would be for the Americans. So look, on balance, I don't think it's likely. And the reason I don't think it's likely is because the US dollar is just a hegemonic currency. And you only have to travel out into the developing world, as I do a lot, and realize that, frankly, the dollar is the main currency in most local countries. Yeah, the dollar is enormously powerful. Yeah, even in the countries that hate America. Yeah, you go to Iran, they would love to get their hands on dollars. Turkey, where Erdogan absolutely hates the Americans at the moment, they love dollars. Yeah, so I don't really think, in truth, because the way the financial plumbing of the global international system works, the dollar is threatened in any meaningful way at the moment. But I also think that worries around indebtedness are overblown. Japan has shown us what can happen to a country that can carry on borrowing. I don't know where US government debt to GDP is at the moment. I'm guessing around 100%, or certainly will be anytime soon. Japan's way over an horizon at 280% at the moment, and showing no particular signs of defaulting on its payments. Yeah. Do I think those are risks at the moment? No. But what I do think is that the gold price is sort of indicating that there are enough people out there who are a little bit worried about the failure of America, that they might want to hedge their bets. Yeah, that they might just want to put a little bit of money aside for a kind of real asset that holds its value. And what I suspect has gone on is that if you talk to most investors, and it's probably me included, I might, in a typical investment portfolio, have had like, I don't know, either no gold or gold equities. And I might have increased it maybe a few years ago to 1 or 2%. Maybe now they're increasing it to 3, 4, 5%. Yeah. And actually, because there's only a limited amount of gold in the world, that, you know, all that extra money could make a big difference to price. And so going back to our point about price discovery, gold is an excellent way of price discovery risk, yeah, or discovering the price of risk. And what the price of gold, even now as it's bobbling around 1900, 2000 an ounce, in dollars ounce, is telling you that the market is pricing in more macroeconomic risk, but it's not pricing in end of the world risk. Because if it was, the gold price would be 4 or 5K, you know, and it's not, and it's struggling to break above 2, yeah. So that's what I think is probably going on. The great unknown in this is China.
Yeah, indeed. I was going to bring, I think you've been reading my script here, but I think that there's this kind of uneasy kind of truce in a sense between China and America, isn't it? Because China's holding all of those US treasuries. But at the same time, you've got the sort of trade spats, you've got the rising geopolitical risk. I mean, to what extent would you put those kind of more political Cold War kind of risks into your consideration of how you'd structure an investment portfolio?
Well, one practical way, and I've talked about this in my FT column, is I would be looking to selectively buy strong aerospace and defense stocks. because in truth, yeah, the demand for military tech ain't going away anywhere. Yeah, you know, that practical terms, I'd probably be looking at that. I think in terms of investment portfolio terms, it's a tricky one, you know, and the reason it's tricky is there is this idea going around that somehow America can contain China. Yeah. And China's articulating it as, you know, we want to have our more internal growth. We don't want to be reliant on foreigners, all that kind of stuff. Yeah, well, I'm not entirely convinced that is the case. And I don't actually think it's terribly possible, because I think anybody who spent any time in China realizes that China is still wedded and embedded into the global economy. And you know, on a practical level, I write a lot about asset managers, and I can tell you now, pretty much every fund manager who's worth anything is trying to buy a business in China. Yeah, they ain't trying to go, no, we won't go near China. No, they're trying to buy Chinese asset managers. Yeah, and that sort of tells you where the game is. Yeah, because of course what they've worked out is that if you're in business and you're an investor, then ignoring China is a problem. Yeah, because it's likely in certain areas that China is going to be very powerful. There's a lot of money sitting in wealth accounts in China. So why wouldn't you, if you're a fund manager, try and invest in the Chinese fund management market? Another concrete example is, I write a lot about fintech. You kindly mentioned AltFi, one of the businesses I'm involved with. And in the fintech market, I mean, the Chinese are bloody good. Yeah. And if you have got a fintech strategy and you don't have any investments in China, what are you doing? Yeah. And financial is a phenomenal fintech business. I mean, it is a brilliant fintech business. Yeah. And Chinese have got a lot of things worked out really well. So there's this conflict between, do you engage with China? Do you make some investments in China? Or do you go to the containment idea, which is thou shalt never invest in China? And you know what, again, as I said at the beginning, I don't think there's any easy answer to this. There's no right or wrong. You've got to navigate your way around it, yeah? And my own personal way of looking at it is, where China has a phenomenal advantage, I think you would be unwise to ignore those sectors. So that's fintech. I think China is going to be phenomenal in life sciences. I think there's some phenomenal stuff coming down the road around Chinese biotech and Chinese life sciences. You know, I think around asset management, I think around wealth management, I think, you know, to ignore it is crazy, but equally you might want to be more cautious about maybe betting on the big Chinese giants, the Alibabas, the Tencents, because it is clear that with Hawaii already, or Hawaii, however they call it, you know, the American government, if it wants to take down a tech giant, yeah, has the weapons to do it, yeah. So I think it's tricky and it's problematic for investors. And I think it's very easy to say, I shall never invest in China, yeah, and I shall just stick all my money in America. And then, you know, 10 years later, you wake up and think, what the hell did I do?
Indeed, yes. So let's try and put your sort of crystal ball to the test a little bit. If we were to say, let's construct a portfolio for the 2020s with a view to it, being as strong as possible, say, by 2030, what would be the kind of main elements you'd want to put into that portfolio, and why would you choose them?
Yeah, okay. Well, I'll list through a couple. I think that personally, that the life sciences sector, the biotech sector, is going to spring some remarkable surprises on us. Hopefully pleasant surprises on us over the next 10 years. I think the advances in genomics, the advances around the kind of the therapy platforms that they call them, that the big genomics companies are building, is going to truly revolutionize medicine. I literally was talking before we came on with an old friend of mine, and sort of explaining over a quick pint that there's something very interesting going on at the moment, which is the genomics companies have been concentrating, for instance, up to now, on orphan diseases, on diseases which the big pharma companies don't really want to touch because it doesn't make much money. But you get a clever bunch of scientists together, stick them in a lab, and they can come up with some cures for diseases that only affect, say, 10, 50, 100,000 people. Now they're beginning to spread their wings, develop genomics delivery platforms, which will be able to attack things like cancer, to be able to attack a lot of potentially even things like, we're not quite there yet, but dementia and all those kind of issues. So I think that personally, if you want me, I'm basically sticking 20-25% of my portfolio into life sciences. Simple as that. I personally prefer earlier stage, but you're not going to go far wrong with GSK or something like that. The next building block is I think that you probably want to think less about countries and think more about thematics, big trends, and trying to capture via either individual companies or via a fund, you can do it either way, where you think that there are big secular drivers and trends that are happening that are just not going away and they're going to intensify. I've sort of mentioned some already. Aging population and asset management, yeah? Aging populations means there's an awful lot more old people out there. They've got an awful lot more money sitting around and they have to do something with it. We talked a bit about that already. And, by and large, they're going to choose wealth managers, fund managers, those kind of all private banks. And that's going to be true, certainly for the developed world and increasingly true for the developing world. So I don't think you'll go far wrong with asset managers and wealth managers. And in fact, you haven't gone far wrong. If you'd invested in AJ Bell or Hargreaves Lansdown in the UK, for instance, you've done very well. So asset management, I think, is an interesting area. I think fintech's another interesting area. These are kind of thematic trends, yeah. These cut across geographies and sometimes cut across sectors, yeah. I think that's another terrifically interesting area. There's lots of stuff going on down there that is truly revolutionary. The whole payments revolution. We've seen it with COVID. It's intensified the end of cash. Cash is dead within 5 years, and the payment systems are remarkable now. A small indicator of it is, when when I was growing up, we all had interest-free credit. We remember that. Now they've got Klarna, and actually PayPal is jumping on act. So you buy something, you get the app, you pay for it in 3 installments. It's doing so well that the regulators have jumped on it, which is usually a good sign. So that's a good example of fintech. The other area that I think that you would be well advised to look about is real assets, property, infrastructure, and I'd look at the right types of property and the right types of infrastructure. Again, it's not going away in the low interest rate environment with money flooding into the system, people wanting income. When I first started writing about infrastructure funds, listed infrastructure funds, they've got a few of them in the UK now. So I started writing about them in 2008, 2009. The average yield you could get would be 6.5%, 7%. The average yield now is 4.5%. That yield compression I talked about. But it's not going away. That stuff's not going away because people want that kind of stuff. And I think that in the current sell-off around real estate investment trusts, everybody's panicked because they think COVID's destroyed the office model. It's certainly gone a long way to destroying the high street retail model, but that was dead anyway. Then I think there's some real bargains to be picked up there, with the right funds and the right managers. So I think those are some of the things I'd identify, real assets, big thematic trends, life sciences. And I suppose that the last thing that I would probably pick up on is you have to have some view around tech stocks. and I sort of slightly mentioned them tangentially with things like fintech, but I mean mainstream tech stocks, you know, the FANGs, you know, the e-gaming companies, all that kind of stuff. You have to have a view about them, yeah? You can't avoid them. They probably, some of them are ridiculously overpriced, yeah? But in the new economy that we all live in, you know, we are spending our money with these people, yeah? And they're attracting the interest of the regulators. And I think that you have to sort of work out, how do you navigate your way around this complex situation? Because if you'd have avoided tech stocks in the last 6 to 9 months, you'd have been a very, very bitter, disappointed person. And in truth, if you'd avoided tech stocks in the last 5 years, you'd have been a very bitter, disappointed person. And I'm not suggesting that you should all go out and buy tech stocks, but I am suggesting that you, as an investor, sort of need to work out where you think the next big leaps are going to be. I've mentioned some of them, but I think there are other things out there as well. So, you know, those are some of the things. And by the way, in that list, nothing was there about fixed income and bonds.
Right.
And that's very, very good reason, because why would you?
Yeah, indeed. But you talk about themes. One of the sort of themes that's done really rather badly in the last decade is value investing.
Yeah.
The contrarian in you thinks that perhaps value investing is now due a turn in the sunshine, and is it something we should be looking at?
Short answer is yes, but you need to be quick and you need to be agile. There's a very good quantitative strategist who works for head of quantitative strategy for SocGen, the big French bank, called Andrew Lapthorne. And I interviewed him a while ago, and he said something very illuminating. He's absolutely right. You're absolutely right. Value has serially underperformed for years, yeah, and it has continued to serially underperform this year. Eventually, markets do mean revert, yeah, and when they mean revert, they snap back quite quickly. But what Andrew said, which I thought was very illuminating, is that snapback is quite often very quick and very rapid, and almost if you blink, you miss it, yeah. So this idea that you can just sit around investing in value stocks and just wait patiently for it to come, well, that hasn't worked out terribly well. You need to be agile and you need to be clever and smart about it. But what I will give you one practical example, I've literally written a note about it this week, is UK equities. By and large, UK equities are on the value end of the spectrum, particularly mid to large caps, domestic economy focused. And they traditionally are more value orientated, and they're certainly cheap, yeah. But they usually have quite good balance sheets. They usually have decent earnings and decent dividend yields, which admittedly have been cut. And at the moment, if you look at it from a value perspective, UK domestic orientated mid to large cap equities are cheap, yeah. And I think that they're cheap for a very good reason at the moment, which is I don't want to go into the politics of it, but international investors haven't been particularly enthusiastic about Brexit. I think that's fair to say, regardless of your views about it. And also COVID. In truth, we have not done a great job on COVID. And I think it's pretty obvious to everybody that, you know, we've not been one of the shining lights on it. So international investors have tended to stay away for those reasons. And therefore the price is probably realistic at the moment. But you can't have your cake and eat it. Or if you're Boris Johnson, you probably can. But you can't basically say that, you know, we've had a terrible time, fully deserved it, and then when these things improve, which they will do, we'll come out the other end of COVID, and then we will come out the other end of Brexit. You can't expect then things not to change, yeah. Then suddenly the reasons why you were bearish and negative might be reasons why you might be positive, because those things that you worried about are no longer an issue, or less of an issue than they were. So my hunch is we will have a phenomenal value snapback in UK domestic equities in probably quite a concentrated period of time, probably just a few months in 2021.
Okay, cool. That's a good tip. Now you talked there about the potential death of cash. We see now central banks doing a lot of work at the moment on digital currencies. What are your thoughts about digital pounds and dollars?
Well, do we mean by that simply fintechy digital pounds or dollars on our cards? Wandering around with our neo banks, our challenger banks. I'm a great fan of. I was getting my Starling Bank. A lovely, great institution. I recommend them. Or do we mean digital currencies?
I mean, the latter, digital.
Yeah. Okay. Fair enough. I'm a lot more cautious around digital currencies. Uh, I spend a lot of time talking to crypto fiends, yeah, and they tell me, yeah, this is could be the rival to gold. And I go, it's not really, is it? Because the gold price pretty stable, actually. In fact, gold's probably one of the less volatile. You can have that word, those two words together. One of the less volatile asset classes out there. You know, it tends to pretty stay in a trading range. Yeah. So for a while, it was stuck in a kind of 1350 to 1550 an ounce range. Now it's sort of stuck in an 1800 to 2000 range. It's not particularly volatile, actually. It's pretty safe. Yeah. Which is what you want from a safe haven. And there are the two words that, unfortunately, cryptocurrencies are not very good at providing: safe and haven. Yeah, they're not terrifically safe. Yeah, we've all heard the stories about people accidentally mislaying their USB stick with £5 million worth of Bitcoin and ends up in a South Wales refuse tip. And haven. Well, have you looked at the price, the Bitcoin price? I mean, it's not exactly a kind of. It's not boring, is it? It's it's pretty damn volatile. But, and here's the important caveat, it's really important that you don't look at this purely from a developed world perspective, yeah? So at the moment, why would I in a developed world want to take my money from a relatively safe currency like sterling or the dollar or the Swiss franc and stick it in Bitcoin? I mean, why, yeah? Except for short-term speculation. But if I'm in Iran or North Korea or the Lebanon or any number of countries around the world that are either failed or failing states, where the dollar is more difficult to get hold of and where I want to be able to preserve the value of my wealth, well, then Bitcoin becomes much more interesting at that point. What I'm waiting for, I'm less interested in. I, for instance, invested in a startup, a crowdfunding startup, which had, and it's very clever, but you've got a little kind of wallet on your phone, you can put it in Bitcoin. I think it's quite fun and interesting idea. And they were saying, oh, well, great, there are loads of Brits who are going to do this and Americans. And I was going, no, not really, actually. There's loads of Zimbabweans and loads of Iranians who do it, but you're not selling it to them. You're selling it to people like us. So I do think, going back to something you said earlier, the world is waiting for another alternative to the dollar and to gold. And at some point, digital currencies might be the answer to it. I'm not completely convinced, in truth, that Bitcoin is it. I think there may be something that comes along that's better. People talked about Ether, Ethereum. Maybe that is it. It actually hasn't proved that way. I think that this is one of those classic ones where cryptocurrencies is great disruptive technology, and everybody goes, that means it must be Bitcoin. But what happens if the disruptors are disrupted? What happens if somebody comes along with a much better cryptocurrency? And obviously, Facebook has tried with Libra and failed by and large. And of course, it had problems. You know, it had problems with the fact that it was Facebook. I think that somebody's out there working on something. And you know what? I wouldn't be terrifically surprised if it's Chinese.
Okay, well, as we come towards the end of our time together, David, if I was to kind of put a gun to your head and kidnap your children and say, what,
please.
What's your number one piece of advice to investors at this moment in history? What would it be?
Oh gosh. Well, it sort of depends on the time frame. I think if you're saying at this exact moment in time, and here we are in I never know where the bug will go out, but end of October, beginning of November. I would say for the next month or two, be very cautious. The US presidential election has got enormous ability to upend every convention. And I think there's going to be a lot more volatility in the next couple of months than we all expect. And the stock market isn't sort of pricing it in at the moment. So I would be, and I am, extremely cautious at the moment and laying money off to the sidelines, waiting and just seeing what's going on. But if I were to jump forward 2 to 3 months now, get myself to February, isn't long. We'll all be locked down for those 3 months anyway, so we've got plenty to do. I would then switch quite radically and say I think it's a massive risk-on trade. I would just ditch, but don't be sitting around in cash. Yeah. Ditch as much as you can of cash and of the safe, boring stuff, and go for a risk-on rally. Some of that might be value. We talked a bit about it. Some of it might be emerging markets. There's lots of stuff that's out there that's interesting. I would be much more aggressively bullish at that point, because I think we're going to come out the other end of COVID. I've already mentioned that. We could have a roaring 20s, could be the roaring 20s again. I think that government policies are sharply redistributionary, and that's actually pretty good news for consumer spending. Bad news for wealthy people, good news for poor consumers, which will be, I think, bullish for a lot of equities. I think we'll probably be a little bit more inflationary, but the central bankers are desperately hoping we will be, which will probably be, again, generally is pretty good news for equities. Equities tend to do fairly well in mildly inflationary circumstances, particularly when consumer spending is going up. So at that point, real assets will probably do well. We'll probably see a continuation of the existing asset bubble in real assets. They probably won't go up as fast as some of the equities will. So my message is, be very, very cautious at this exact moment in time. But flash forward 2 or 3 months as we come out of COVID, and we will come out of COVID. I mean, eventually, even our government will get things like testing right. We'll get things like, which we should have been doing at the beginning, testing every school, every university, every hospital every week. Yeah, that's what you need to do. There's this ridiculous debate going on about lockdown versus kind of herd immunity, and it's slightly, I don't really get that argument, but the answers are out there, which you test. Yeah, test as often as you can, as many people as you can, and then eventually you get to a number that you can properly track and trace, and we can begin to compress the numbers down, and we can begin to manage this thing. Yeah, and we'll get there. And at that point, the situation, maybe we'll get a vaccine, I don't know. That point, everybody will suddenly change their view quite rapidly. And going back to my point I said about Andrew Lapthorne on value, when markets turn and swivel, they move very fast. Yeah. And if you're just too cautious and saying, oh, I still think the world's going to end, you could lose out on some very, very big gains.
Okay, great advice to end on there. David Stevenson, thank you very much for joining us.
Pleasure. Thanks, Graham.